Hello everybody, my name is Nicole and I'm a technical analyst and private investor. And I don't know if, like me, you've been thinking that not much has been happening in the markets over the last 6 or 7 working days or so. Just because the stock market isn't doing very much doesn't mean to say things are happening elsewhere. So what you've got to do not assume quiet markets mean that everything's all right. It's not. To give you some idea, the US Treasury has auctioned this week the best part of $100 billion worth of 2- and 5-year treasuries. The 5-year hit a new record low of 33 basis points. Over in Austria, they've sold another tranche of a 100-year bond. Now, they sold one of these 3 years ago with a coupon of 2.1%. It was snapped up and is possibly the best investment you could have made over the last 3 years, returning 120% of your money. This week's version is another 100 years, just 2 billion, mind you, they're just 2 billion, and yet it was 8 times oversubscribed with a coupon of 88 basis points, a yield of 88 basis points. Now, why are people doing this? Well, stuff it in Austria rather than give over money to the European Central Bank, hey? I mean, it's not difficult. Anyway, my first chart is a daily chart of the S&P 500 index. Now be careful, I use the index, other people use other vendors' prices, and they will not be the same. My index, if you can see, last week had a tiny, tiny little 4-day island. Just retreated from there, nothing very special, tiny little ranges. Now at the bottom of the chart, you'll see I've plotted actual observed volatility, also known as historical volatility. So what is the change in price from one close to the next close, averaged over, I think the average is 14 days. And you can see that the observed volatility this month has picked up from a low of 12%, which is the lowest it's been in quite some time, reflecting the tiny little price moves we've been seeing. But now recently, we've had a big rise to 37%. So that's almost threefold. I mean, I know it doesn't look much on the chart, but, you know, if your insurer told you, you know, your premium's going to go up threefold, I mean, you'd just gag, wouldn't you? Anyway, what we've now seen after the little island, we've seen tiny ranges. The moving averages of the Ichimoku chart system have crossed to bearish. We've still got support from the cloud and all the rest of it. But I've just got a feeling that Fibonacci resistance from which we've retreated and the previous trendline support, which is now trendline resistance, from which the lagging line has retreated, might mark an interim high. May do so, we'll see. So moving over to my second chart, this is the much touted VIX index. Now, I should warn you that this is a mishmash of a whole load of puts and calls and what the implied volatility on this basket. Now, this is a very rough measure. I mean, in foreign exchange, we always divide out separately put and call implied volatility. You know, but as you can see, this one is far more expensive than observed volatility, moving from a low of 23% to 43% for a month's worth of cover. My third and final chart is the Footsie daily, which is spectacularly boring and is merely hovering halfway between this year's high and this year's low. That's all. It again seems that the Fibonacci 61% retracement has capped. Moving averages have crossed to bearish. And what we've seen over the last few days, we possibly might be at a bottom of a broadening top formation. These are all miniature patterns, miniature. Get out your magnifying glass, you're going to need it. And good luck. And I'll see you next week and see if we can come up with something a little bit more exciting.